Welcome to the deep dive. Today, we're asking a question that, well, I think it's on a lot of people's minds. Just how healthy is the U.S. equity market right now? We're talking mid-July 2025. We've gathered a whole set of really comprehensive analyses. Think of it like a full financial checkup for the market, trying to figure out where things actually stand. And our mission here really is to cut through all the chatter, pull out the most crucial insights from these detailed sources, and give you a kind of shortcut to being properly informed about, market valuation and maybe what the future holds.
Yeah, and it's important to stress these aren't just like opinions off the cuff. The sources we're digging into today are very data-driven. They use time-tested metrics, lots of historical comparisons. It gives us a pretty robust, almost you could say, scientific basis for understanding where the market is right now. It's about the numbers, not just the headlines.
Absolutely. And look, to make sure we cover everything clearly, we're going to follow the structure from our source material. It's broken down into 6 chapters. This way, we can take a really organized journey from the big warnings down to the specific details. So yeah, let's dive in. Okay, chapter 1, our sources call it a precarious Zenith. Wow, that title alone, it paints a picture, doesn't it? So let's unpack this. What does a precarious Zenith mean in plain English for the U.S. market right now? And what are the big takeaways from the executive summary?
Precarious Zenith. Yeah, it really sets the tone. Basically, it means the market is showing some serious signs of being overvalued. A lot of key metrics are hitting levels, that rival or even beat some major historical bubbles. And what's really striking is how it got here. It hasn't been a broad market rally. It's been almost entirely powered by a really narrow group of these mega cap tech firms. The summary then kind of boils this down into 4 main factors. First up, extreme valuation multiples. We're talking about classic gauges like the Buffett Indicator, the KPE ratio. They're at or near all-time highs. And the uncomfortable truth is, historically, levels like these have almost always come before periods of really low, sometimes even negative returns over the next 10 years. That extra return you expect for taking equity risk, measured by the excess CAPE yield. It's tiny right now, just 0.60%, barely anything. Second factor, elevated systemic leverage, debt. Across the board, corporations, households, the government debt levels are at or near record highs. For companies, there's this looming refinancing wall. A lot of the cheap debt they took on years ago is maturing.
Now they have to roll it over at today's much higher interest rates. That's bound to squeeze profits. And for the government, all that debt means less firepower for fiscal stimulus if the economy hits a rough patch. Their hands are a bit tied. Third, and this one's a biggie, narrow market leadership and concentration. The market is incredibly dependent on the magnificent 7 stocks. You know the names? This concentration. It's actually even more extreme than the old Nifty 50 era back in the 70s, and it's looking a lot like the dot-com bubble concentration, just to put a number on it. The top 10 companies make up a massive 38% of the S&P 500's value right now. That's huge. And finally, number 4 is investor complacency. This is a classic contrarian red flag. You see this split. The so-called smart money, institutional investors, they seem cautious. They're building up cash reserves. But retail investors, their leverage, things like FINRA margin debt, it's pretty high. When the pros are cautious and the crowd is borrowing to pile in, well, history suggests that often ends badly.
Okay, so let me see if I've got this. It's like this convergence, right? You've got the sky-high valuations, mountains of debt everywhere, the whole market leaning on just a few giant stocks, and individual investors seem pretty unfazed, maybe even a bit giddy. And all that together points to a really, let's say, unfavorable risk-reward picture, suggesting that expecting historical average returns from stocks is, well, probably unrealistic going forward. Low single-digit returns, maybe even losing money after inflation over the next decade. That starts to sound like a real possibility. That's pretty sobering. Right, let's pull back now, get that 30,000-foot view. We're moving to chapter 2. Aggregate market valuation. What are the big, broad, time-tested metrics telling us about just how high this market is flying?
Well, the striking thing here is just how consistent the message is from these long-term measures. Take the Buffett Indicator, total market cap to GDP. Buffett himself called it probably the best single measure of where valuations stand. Right now, sources estimate the total U.S. stock market cap is around $62.7 trillion. Q1 2025 GDP was about $29.96 trillion. So you do the math, that puts the indicator around 209%. 209?
Whoa.
Yeah. It means the value of the stock market is more than double the entire country's annual economic output.
That just sounds astronomical.
It is. It's completely unprecedented. It blows past the dot-com peak back in March 2000. That was 159%. It's even higher than the peaks in late 2021. And you remember Buffett's warning, right? That hitting 200% is like playing with fire. We're past that now. And sure, people argue the economy's changed, structural shifts and all that. But even if you adjust for long-term trends, today's reading is way, way above the historical norm. It implies the market's pricing in this incredibly rosy future, maybe unrealistically rosy.
Okay, 209%. That's a stark number. But is it just one indicator flashing red? This is where, things get really interesting with another big one, the Shiller KP ratio. What is that exactly, and is it telling the same story?
It absolutely is. It's another really important piece of this valuation puzzle. The Shiller KP, that's the cyclically adjusted price-to-earnings ratio. It basically smooths out earnings over the last 10 years, adjusted for inflation, to get rid of the noise from short-term business cycles. Gives you a longer-term view. Right now, it's standing at a pretty formidable 37.81.
37.8. And how does that compare historically?
Well, its long-term average is about 17.3. So we're more than double the historical average right now. Think about that. More than double. This level, 37.8, it's only really been significantly higher once before. Right at the peak of the dot-com mania in December 99, when it hit 44.2. It's actually higher than it was just before the 1929 crash. That was 32.6. And it's higher than the 2021 peak, too. And the history here is really clear. High starting C/Q ratios have consistently, almost inevitably, led to poor returns over the next 10, even 20 years in real terms. Plus, that excess CAPE yield we talked about, still just 0.60%. The long-term average is 4.61%. It tells you there's almost no extra reward being offered right now for the risk you take holding stocks versus safe bonds.
Wow. Okay, so the Buffett indicator is flashing bright red. Shiller Kiki is echoing it loudly. But what about, you called it a mosaic of multiples earlier. Do other traditional metrics, price to earnings, price to sales, do they all line up with this picture? Or are there any saying, hold on, maybe it's not that bad?
That's a great question. And honestly, what makes the current situation so compelling, or maybe concerning, is the sheer consistency. There really aren't any major time-tested valuation metrics telling a different story. They all point to significant overvaluation. Take the simple trailing PE for the S&P 500. It's around 25.9 right now. The modern era average is about 19.4. So we're way above average, in the 84th percentile historically. Even the forward PE, which uses analysts' optimistic forecasts for future earnings, is at 22.3. That's higher than its 5-year average, higher than its 10-year average. And look at price to sales. The PS ratio. S&P 500 is at 2.82. That's near its all-time high from 2021, which was 3.04. And importantly, it's higher than almost any point during the dot-com peak. Price to sales is interesting because it's less affected by accounting choices about profits. It just looks at revenue and price to book. Also near record highs at 4.6888. So when you see this consistency across all these different ways of measuring value, earnings, sales, book value, the whole economy, it makes the signal really robust. It's not just one weird reading. It looks like a pervasive state of, being expensive.
Right, and being expensive, as you said, gets way more dangerous when there's a lot of debt around. So let's shift to that. Chapter 3, cracks in the foundation, assessing balance sheet integrity. What's the story with debt across the economy? How solid is that foundation?
Yeah, you nailed it. Leverage is the amplifier.
Right.
It makes good times better, but it makes bad times much, much worse. High debt is dangerous, especially when valuations are stretched like this. So let's look at corporations first. U.S. non-financial corporate debt, it hit a record $13.95 trillion in the first quarter of 2025. A huge number.
13.9 trillion. Wow.
Trillion, yeah. And the really worrying part is this refinancing wall we mentioned. A massive amount of that debt was issued back when interest rates were basically zero. Now, that debt is starting to mature. Companies have to replace it, refinance it at today's much higher rates. Think, the 10-year Treasury is yielding around 4.4% now. That jump in interest costs, it has to squeeze profit margins and cash flow. It just has to. It seems like a fundamental mismatch with the market's still pretty optimistic earnings forecast. It's like, imagine your adjustable rate mortgage suddenly resetting much higher. That's what a lot of companies are facing.
That's a really clear analogy. Okay, so companies are facing that pressure. What about the consumer? Households drive something like, 68% of GDP. How are they holding up? Are their balance sheets okay?
The consumer picture is, well, it's mixed, maybe a bit nuanced. Total household debt is at a new record high, about $18.2 trillion. But, and this is important, as a percentage of GDP, it's around 69%. That's actually quite a bit lower than the really scary peak of nearly 100% we saw right before the 2008 crisis. So we're not seeing quite the same level of household balance sheet fragility as back then. However, the household debt service ratio, that's the percentage of disposable income people are spending just to service their debts. Mortgage, credit cards, car loans. That was 11.25% in Q1 2025. And it's been steadily climbing. It directly shows the bite that higher interest rates are taking out of family budgets. More money going to interest payments means less money for spending, less for saving. It makes consumers more vulnerable if the economy slows down, or worse, if job losses pick up.
Okay, so maybe consumers are stretched, but not quite at the breaking point like 2008. But,
Yeah.
If things do turn sour, we often look to the government, the sovereign backstop. Does the government have the ammo to step in big this time if needed? What do the sources say about that?
That's a really critical question right now. And the sources suggest the government's capacity for another massive fiscal rescue is, well, significantly less than it used to be. U.S. federal debt is now around 124% of GDP. That's a level we've historically only seen right after World War II. Huge debt load. And it's not just us. Total global debt hit over $324 trillion in Q1 2025. So the implication is that the old reliable government put the idea that the government can always step in with massive spending to cushion a market crash or recession. It might be less certain now, or at least less potent. It suggests that if we do get a downturn, it could potentially be deeper, maybe last longer, because that main backstop just doesn't have the same financial flexibility it once did. So yeah, the picture across all sectors, corporate, household, government, is consistently one of high, and in some cases, record leverage.
That's concerning thought about the government's ability to react. Okay, let's change perspective a bit. Chapter 4, Echoes of the Past. Benchmarking against historical manias. History doesn't repeat, but it rhymes, right? What kind of unsettling echoes are sources picking up between today's market and previous bubbles or manias?
Exactly. The rhymes are definitely there, and some are quite loud. Look at the Magnificent Seven today. Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, Tesla. The narrative around them feels very similar to the Nifty 50 back in the early 1970s. Back then, you had stocks like Xerox, IBM, Polaroid, seen as one-decision stocks. Buy them, hold them forever, price doesn't matter. That was the thinking. The Nifty 50 on average traded at a PE ratio of about 42 times earnings, while the rest of the S&P 500 was around 19x. Today, the Mag 7 as a group traded a forward PE of maybe 26 to 28x. Still a big premium to the rest of the market, which is closer to 18 or 19x if you exclude them. But here's where today might be even more extreme. The concentration. We said it before, the top 10 S&P 500 stocks are 38% of the index. The top 5 are 28%. That level of concentration is actually higher than during the Nifty 50 peak. And the lesson from the Nifty 50 is pretty brutal, isn't it? Many of those can't-miss stocks fell 70, 80, even 90% during the stagflation of 7 through 74. It just hammers home the point. Even fantastic companies can be terrible investments if you pay too much. Today's valuations, like back then, seem to leave absolutely no room for error. It's priced for perfection.
Yeah, that no room for error phrase really sticks. Okay, what about the other big one, the dot-com bubble? Late 90s, early 2000. How does today stack up against that frenzy, especially with all the AI excitement?
Well, there are definitely echoes there, too. The S&P 500's current trailing PE, around 25.9, is getting uncomfortably close to the peak PE in 2000, which was about 29. But the price-to-sales ratio comparison is maybe even more striking. Today's PS of 2.82 is actually higher than it was at almost any point during the dot-com peak, which topped out around 2.3. Market concentration, again, looks very similar. The share of the top 30 companies in the S&P 500 is now 53%, the highest it's been since at least 1999. And yeah, the investor behavior, the excitement around AI, the elevated margin debt, it definitely mirrors the kind of speculative fervor we saw back then with the internet. But, and this is a really important distinction the sources make, there's a key difference. The dot-com bubble was largely fueled by hype. Lots of companies with no profits, sometimes no real revenue, just an idea and a dot-com name. Today's leaders, the Magnificent Seven, they are, as the sources put it, immensely profitable, cash-generating behemoths. They make real money, lots of it. So maybe it's less of a hype bubble and more of a profitable bubble, but the risk is still there, right?
Their growth has been incredible, truly extraordinary. But eventually, that growth has to slow down. Maybe it goes from extraordinary to just very good. The problem is current valuations don't seem to reflect any potential slowdown. They're still priced as if that extraordinary growth can continue indefinitely. Price for perfection, again.
Okay, so we've looked at the big numbers, the historical parallels. What about market psychology? Let's move to Chapter 5, gauging smart money and retail sentiment. Are the big, sophisticated investors doing one thing while the retail crowd is doing another? What are those tea leaves telling us?
Yeah, this is often where you see some classic divergences near market tops or bottoms. And right now, the picture's pretty clear. If you look at the smart money like Berkshire Hathaway, Warren Buffett's firm, their portfolio is still very concentrated in a few names. But the really telling signal, their cash pile. Cash and short-term treasuries have swollen to record levels on their balance sheet. That tells you one of the world's most respected investors is finding very few things to buy at prices he considers attractive. He's sitting on the sidelines, patient, cautious. That's a loud signal. Then you got Michael Burry, Cyan Asset Management, famous from the Big Short, right? His moves in the first quarter of 2025 were pretty dramatic. He sold almost all his long stocks, including a bunch of Chinese tech he'd held. He ended up holding basically just one main long position, Estee Lauder. But more importantly, he bought significant bearish put options against NVIDIA and also against some Chinese tech ETFs. He's betting on prices going down. So you have Buffett, very patient, holding cash. You have Burry actively betting against key parts of the market. Very different styles, but the direction is similar.
They see limited upside and potentially significant downside risk. They're playing defense.
That's fascinating. Two very different approaches, but both signaling caution. How does that line up with what retail investors are doing? Are they feeling cautious too, or is it a different story?
It's a very different story.
Yeah.
And yeah, it sets up that classic contrarian picture. Indicators tracking retail sentiment and activity show quite a bit of optimism and risk-taking. Take FINRA margin debt, that's money people borrow from their brokers to buy more stock. As of May 2025, it was $921 billion. That's a big number, and it had increased quite a bit over the previous year. Historically, big run-ups in margin debt like this often happen near market peaks because that borrowed money amplifies gains on the way up, but it forces selling, sometimes catastrophic selling, on the way down.
Right, margin calls.
Exactly. Then you look at sentiment surveys, like the AII bull-bear spread. The latest reading was positive, plus 5.7%, so 41.4% bullish, 35.6% bearish. Now, that's not extreme euphoria, not like everyone's wildly bullish, but it shows a persistent optimism, a lack of real fear among individual investors. From a contrarian perspective, that often means most of the people who might buy have already bought. There aren't many buyers left on the sidelines. Even things like Google searches for stock market crash are relatively low. Those searches tend to spike near market bottoms when fear is highest. Low search volume now suggests complacency. So you put it all together. Retail investors seem pretty fully invested, both psychologically and financially, often using leverage. That leaves very few marginal buyers and a lot of potential forced sellers if things get rocky.
Okay, this has been a deep dive indeed, which brings us perfectly to our final chapter, Chapter 6, Synthesis and Forward Return Implications. We've looked at valuations, debt, concentration, history, sentiment. Let's try to pull it all together. What does all this evidence add up to? And really, what does it mean for you listening right now and thinking about your investments?
Right, the synthesis. So the bull case, let's be fair, it hinges on the very real profitability of those big tech leaders, the Magnificent Seven, and the truly transformative potential of AI. Analysts are still forecasting strong earnings growth, mostly driven by these companies. And the narrative is powerful. AI is a game changer. It justifies these high valuations. You hear that a lot. But our analysis, looking across all these chapters, strongly suggests that this optimistic story is, well, probably more than fully baked into current prices. The evidence for the bear case is just so broad and deep. Valuation is extreme, historically speaking, by almost any reliable measure. Check. Systemic leverage, corporate, household government is very high. Check. Market structure is dangerously concentrated. Check. Investor sentiment is complacent. Check. So the core conflict is, can the undeniable fundamental strength of a handful of amazing companies defy gravity? Can it overcome extreme valuation, high debt, market concentration, and just plain historical precedent? History tells us that's a really, really tough ask. It rarely happens. And this leads us straight to what some call the unforgiving math of mean reversion. Basically, where you start in terms of valuation has a huge impact on your long-term returns. If you plot the starting Shiller-Cape ratio against the actual real returns investors got over the following 10 years, the relationship is incredibly strong and it's inverse. High starting Cape equals low future returns. With today's Cape at 37.8, what does history suggest? It strongly points to a probable range for 10-year forward real returns after inflation of somewhere between -2% and +3% per year.
-2 to +3% per year for 10 years.
Yeah. Think about that. A decade where you might actually lose purchasing power, or maybe just barely break even. And that tiny excess Cape yield of 0.60%, it confirms it. You're getting almost no extra expected return for the risk of owning stocks compared to just holding safe, inflation-protected government bonds. So how does this resolve? How does the market get back to more normal valuations? Our sources suggest two main paths. Path A is the crash, a sharp, painful drop in prices. It front-loads the negative returns, gets the pain over with quickly, maybe sets the stage for better returns after that. Path B is the long stagnation. Prices basically go sideways, maybe drift up slightly, but fail to keep pace with inflation for many years. You get a lost decade of near zero real returns, kind of like what happened to investors who bought at the 2000 peak. Either way, crash or stagnation, the outcome for investors starting today looks likely to be deeply unsatisfactory real returns, as the source puts it. The big uncertainty isn't really if returns will be poor from these levels, but how that poor performance plays out. Will it be sharp and sudden, or a long, slow grind?
Okay, so the inescapable conclusion from weighing all this evidence seems pretty clear. The U.S. stock market is definitely playing in the historical danger zone in terms of valuation, and that's a situation that has, well, always eventually resolved itself through long periods of disappointing returns for investors. That powerful AI narrative, it seems like it's already fully reflected, maybe over-reflected, in current prices, leaving, like you said, no room for error, a market priced for perfection.
Exactly. And that leads to some pretty important strategic thoughts for you, the listener, to consider. First, maybe rethink heavy exposure to passive, market cap weighted U.S. stock index funds, because by design, they're most heavily invested in the biggest, most expensive, most concentrated parts of the market right now. Something like an equal weight S&P 500 approach, which spreads the money more evenly, might be more prudent. Second, maybe look at increasing allocations to areas with more reasonable starting points, better valuations. That could mean certain international developed markets, maybe some emerging markets, or even specific value-oriented sectors here in the U.S. that have been kind of left behind. Third, really focus on quality and valuation discipline in any individual stocks you own. Prioritize companies with strong balance sheets, low debt, and businesses that generate reliable cash flow, even in tougher times. And finally, just mentally prepare. Prepare for potentially higher volatility and definitely lower overall returns than we've gotten used to over the last decade or so. It probably makes sense to adjust your long-term return expectations downwards.
It looks like a more challenging landscape ahead.
Okay, a lot to think about there. Let's end with this final thought for you to ponder. If market history consistently teaches us that perfection is rarely achieved and certainly not sustained, what might be the biggest blind spot for investors today who genuinely believe that this time is different?